Gold remains in a relative range as the equity markets have really been in a pretty significant uptrend. Will, what are your thoughts here? Because you would think the interest rate conversation would really add some pressure to gold.
That's right. And I think one of the big changes that's happened over the last few years is the breakdown in the negative or inverse correlation that gold has with the US dollar. So traditionally, when the dollar has risen, gold prices have fallen. However, that seems to have broken down, and we haven't seen that certainly over the last sort of couple of years, which has been positive for gold.
So if we take a look at the one-year chart on gold, is this a time for investors to get a little bit more constructive on it?
I think when it comes to gold at the moment, the fundamentals are intact. We have good demand coming from China and from India and other parts of the world. Central banks continue to be buyers of gold. Jewelry demand remains strong as the price is lower than it has been over the last few years. But I think from an investor perspective, we need a little bit more investor participation at the moment worldwide for the price to react accordingly.
So interest rates are getting pushed out, obviously, maybe the second half of 2015 as compared to an expectation of 2 to 3 U.S. interest rate hikes. Do you think because it has been pushed out so far, is 0.25% really going to make that much of a difference where you're going to see gold spike down dramatically?
I don't think so. And you're exactly right that interest rate expectations, while I think the consensus still is that we will see a rate rise here in the US this year, it's gone from being early in the year and multiple rate rises to now probably the end of the year and maybe one rate rise. All of which I think is positive for gold because while nominal interest rates are low and real interest rates are even negative, that's a positive environment for gold.
And in addition, if you are under the expectation that equity markets might be a bit inflated and there could be a pullback there, in addition to what you're saying with interest rate hikes, this could be an interesting entry for a longer term position.
That's right. I mean, I think investors have been also looking at the broader spectrum particularly for sovereign bonds. And let's not forget that there's over $1 trillion worth of European sovereign debt outstanding at the moment that yields negative interest rates. So that's $1 trillion worth of debt with an interest rate lower than gold, because of course gold yields zero.
Okay, thanks very much, Will.
Thank you.
For TheStreet in New York, I'm Jill Malandrino.